Bloomberg Audio Studios. Podcasts, radio, news. You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
There's a lot going on in media, or we keep hearing that there's going to be a lot going on in media because some companies are up for sale and other companies are looking to buy, but we haven't gotten any actual bids just yet. Geetha Ranganathan is our U.S. media analyst here at Bloomberg Intelligence. And Geetha, we've been looking at Warner Brothers because it has announced plans to split itself up to extract more value. David Zaslav, the CEO, we know is a deal maker. Yet it just came out with results that showed revenue in the third quarter dropped 6% from a year ago. What does this mean for its plan to sell itself?
So fundamentals, Scarlet, really don't matter all that much at this point, especially. Yes, the TV networks business, as we know now for many, many quarters, has been severely challenged. We saw a 20% slump in TV advertising. We saw a 20% decline in TV EBITDA. This was kind of well expected. And this really speaks to why they need to separate themselves, why they need to separate the low growth, or rather the no growth TV assets from the part of the business that's actually growing, which is studio and streaming. That part of the business actually posted really good numbers. We saw the studio. Warner Brothers has actually been having a very, very successful run at the box office this year. They have about a 27% share of domestic box office, and we've seen that kind of translate into really strong EBITDA numbers. And so we saw studio and streaming actually put up really, really good numbers. And that again speaks to why so many different parties, including a Netflix, including a Comcast, are interested in going after those studio and streaming assets. So right now, again, fundamentals don't matter that much. It's really all about the M&A.
And I'm actually surprised, Geetha, that maybe we haven't had some more news on the M&A front, because we've seen, the M&A environment is very, very active. The market's very receptive to M&A here. We have a willing seller in terms of David Zaslav and the board of directors here. How do you think this is going to play out? Is somebody going to make a bid for the entire company, or just maybe the good pieces for it?
We're having all possible permutations and combinations here, Paul. So we know that Paramount Skydance is actually interested in all of the company, including the TV networks. They've already made 3 bids. The highest one was for $23.50 per share for Warner Brothers Discovery, all of it. That was turned down. So they obviously have to come up with a much better offer. Now, the other bidders, and the two that are most often mentioned, are Netflix and Comcast. They are the ones that are only interested in the studio and streaming assets, no interest at all in the TV linear network business. We know that Netflix has started looking into the books of Warner Brothers Discovery. This doesn't necessarily mean that they have to come out with a bid. I mean, remember, Zaslav is, as you just mentioned, he's a very, very tough negotiator. He's a deal maker. He is going to make sure that they really get paid well for the streaming and studio assets if they sell that. And we expect, a price tag somewhere in the ballpark of about 75 to 80 billion. So, whoever makes a big bid has to cough up a huge chunk of change for this asset.
So we keep talking about how it's Netflix, Comcast, and Paramount Skydance. Could there be another bidder that emerges from the shadows?
Absolutely. I mean, you can never rule out big tech. Amazon obviously has shown some interest in the past. They bought the MGM studio. We're not necessarily sure whether they've actually taken a look at the Warner Brothers assets. But again, Scarlett, as you kind of think about the whole media landscape and you kind of think about the various assets out there, this is kind of a once in a lifetime, kind of a generational opportunity for anybody who wants to get big in media to really go after Warner. I mean, they have some of the best IP out there. They have a streaming business that has performed really well. HBO Max is a name that resonates across the globe. So anybody and everybody should really be taking a look at this asset. So I wouldn't be surprised if we have some kind of a dark horse bidder here. Okay,
speaking of media companies with names, brands that really resonate, Disney's ESPN dropped Penn National as its sports betting partner and has picked up DraftKings. Why didn't it just do that the first time around?
Yeah, that's a great question. So if you remember, actually 2-3 years ago, they were in talks with DraftKings. I think it ultimately came down to price. I think they got a much better deal with Penn, which was paying them something like about $2 billion over 10 years. The thing is that they were really a late mover. By the time ESPN Bet came to the market with Penn, DraftKings and FanDuel had already kind of really consolidated their share in the market. They have about a 70% share of the sports betting market. Penn had a lot of problems. Yes, they kind of got the product out there. They have just about maybe a 3% share. They just haven't been able to kind of convert users. The user experience hasn't been good. So I think, ESPN did make a good decision in dropping them and going back to DraftKings.
Mickey Mouse and sports betting. I never thought I'd see that.
I know, right?
Yeah.
Well, but once upon a time, they were like, we're not getting into any of that.
Exactly. You're exactly right. Hey, Geetha, I see our good friends at Comcast. Speaking of Comcast, they have plans to split their cable networks apart from their broadband and cable TV businesses, and they're going to call this lovely company Versant. Go figure. But I understand they're going to have an investor day December 4th. So it sounds like Comcast is moving forward on this split here. Give us a sense of what do you think Versant will look like, and when do you think that split's going to happen?
The split's going to happen before year end falls, and they've got all the pieces moving here. This is really all of the cable networks other than Bravo, so we have the USA Network, we have Golf, Sci-Fi, all of these networks that they're kind of splitting out. Again, the problem with the cable network business is that it is severely challenged, more so than the broadcast business, which is why they're still keeping NBC broadcast, they're keeping the Peacock streaming platform. It's just these cable networks that have been severely challenged. As we kind of model out advertising, affiliate fees, and EBITDA, we're kind of looking for, mid-single digit EBITDA decline, but it still does throw out a good amount of cash. So we're, as we kind of look at it, it's about $2.6 billion in cash. So again, still a decent business.
Geetha, why is Bravo so valuable then to Comcast?
Because they have a lot of content and nonfiction content that they put from Bravo to Peacock, and they didn't necessarily. It doesn't, cheap to make, and it doesn't necessarily fit with the rest of the portfolio. So wanted to hold on to that.
Cheap to make. I think that's a theme here, Paul.
I know, and it's also about sports as well. And the sports is still working for these networks, and mostly the broadcast.
Well, they all paid up a ton.
Yep.
So it's the only appointment viewing.
Exactly right. Is Warner Brothers Discovery still thinking about a split here, Geetha? 30 seconds.
It's anybody's guess, Paul. But right now, if they don't get the price that they want, which we think is upwards of $30 a share for the entire company, I think they will go ahead with the split. And I think Zaslav is willing to wait this out, and we'll see that split happen sometime in the middle of 2026.
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
All right, let's talk a little technology, because we got technology earnings all over the place. Mandeep Singh joins us here, research head of Bloomberg Intelligence on tech stories. Uber, Lyft, they reported some numbers. DoorDash repeated. So are people... Talk to us about that segment of the economy, the ride sharing, the outsourcing, the third party delivery. Are people still spending money on that stuff?
They are, and all these companies. I mean, Uber reported over 20% growth. DoorDash reported 25% top line growth. Even though the stock reaction was negative, that was primarily because they plan to spend more money next year on building their tech stack. I think what the playbook here is to expand in more geographies, as well as branch out into other areas of last mile delivery. And in the case of DoorDash, they're experimenting with delivering food without a courier, human person involved, and also expanding into restaurant point of sale devices. I mean, they're developing technology where you can pay using a DoorDash hardware and point of sale device. So clearly there is a lot that these companies are doing beyond, the original business that they had.
When you spend time in England and you go pay for a meal, the card never leaves your presence. Mm-hmm. They just tap it on some machine and boom, you're all done. Here, they take it, they put it in a little folder, they take it away for 5 minutes.
And that's what you pay 20% for.
You don't know where it's going. And that's why I'm surprised we're so behind here in the U.S. about that point.
We've always been
payment.
kind of behind, though.
Yes.
That's been our calling card.
The way to think about it is there are so many legacy systems that anytime you have new technology, even everyone is talking about AI agents and whatnot, it has to sit on top of a lot of legacy technology. And the promise of AI is it can rewrite a lot of that legacy code and migrate into the modern technology, but we have yet to come across real proof points of that.
So when you were talking, Mandeep, I noticed that you talked a lot about how these companies are spending, they're investing, and I'm curious about the reception that gets from investors, because initially in the big AI buildup, everyone was excited about these plans. But now more and more, everyone's like, oh, I'm not so sure that's a great idea that you're spending so much, whether it's on AI or whether it's on new products and internal platform like it is with DoorDash. Why do you think investors are now more skeptical about this idea of companies spending?
Well, just because we've seen, Uber and all these companies really struggle with free cash flow initially. I mean, in the ZERP era, these companies burned a lot of cash. Now they have gotten to a point where the business model does generate, $7 to $8 billion in free cash flow for Uber. And even for DoorDash, it's 20% EBITDA margin. So the fact that they're talking about spending again, it makes you think, okay, if you're an investor, you waited all this while for these companies to get mature and, start delivering on cash. And now they're talking about another investment cycle. And that's where, in the case of Uber, their hand is forced by Waymo launching on 10 cities and really expanding, and potentially Tesla. I think in the case of DoorDash, they feel, making acquisitions will help them expand their geographic footprint. And then obviously they want to expand their tech stack to more areas.
Most important, do you arbitrage Lyft versus Uber?
I don't these days, simply because I think what Uber has done well is they know my preferences, especially when it comes to business travel, and their frequency and their ability to reduce wait times is far beyond anyone else in terms of giving me a ride wherever I am. And shrinking that wait time. I think that's very important when you compare it to autonomous driving. Like, I could go to San Francisco and get a Waymo, but then I have to wait for 5 minutes, whereas I get an Uber in less than a minute. So that's where, if you really care about your time, you still go for Uber.
Yeah, I use Lyft because I have a Chase card and I get a $10 a month credit.
Loyalty points is another aspect,
Stay with us. More from Bloomberg Intelligence coming up after this.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts, or watch us live on YouTube.
Let's talk a little bit about companies that are affected not just by tariffs, but by a consumer that perhaps is somewhat weakened, a little bit more cautious given the softness in the job market. Let's bring in Poonam Goyal. She is our senior U.S. e-commerce and retail analyst to talk a little bit about Under Armour, whose shares are down about 5% in late morning trading. Poonam, when it comes to Under Armour, how much of the struggles that this company is experiencing is due to things like tariffs, which is beyond its control, versus an overall product selection and a consumer whose taste might have shifted?
Sure. I think it's a combination of both. When you look at the top line, it's really self-inflicted, right? They're trading out of off price. They're trying to drive more full price sales. They're really revamping their whole message, trying to resonate better with consumers. So that's why we continue to see weakness there. They need to drive more product innovation. But then when it comes to margins, it's a little bit of both. Tariffs are impacting them. In fact, more than some of our other companies who have been largely able to offset these headwinds, they are not able to. And that's sending gross margins down about 200 basis points for their fiscal year.
So I think about that, athletic market, Poonam, it just feels super, uber competitive to me. Is this a place where Under Armour can win vis-a-vis the Nikes of the world, the Adidas?
Yeah, look, I think the market is growing in competitiveness. You're absolutely right. It feels like every company right now in the athleisure space is on a reset mode. When you think of Nike, they're under reset, Puma's under reset, Under Armour's under reset, right? So they're all going after the same customer, but in a different way. Nike, clearly the giant in the room. They have the dollars to invest in brand marketing and endorsements, so they can continue to step harder on innovation. When it comes to Under Armour, I think we've heard the story so many times now, Paul. I mean, I've heard their turnaround and seen it go up and then away every couple of years. So will this be the time they get it right? It's really hard to tell because right now they've controlled their inventories, which is a good thing. They're down 6%. They're down more than the sales decline. But the innovation ebbs and flows. So will it stick? Will the consumer, stay committed and loyal to Under Armour? I don't think the consumer is loyal to anything today.
That's a really good point. They're loyal to price. Price first is what they're loyal to, and deals. Poonam, Under Armour also announced a new executive, a new CFO for the company. Reza Taleghani will be taking over starting in February. Does this raise concerns about not leadership so much, but in terms of strategy for the company? Because as you mentioned, feels like Under Armour has been in turnaround mode for a long time.
It doesn't concern me about the strategy. He was a CFO in his prior role as well with another company. I think the leadership is really identified by the CEO, Kevin Plank, in this example, and he has a plan to lead this turnaround. And the plan is pretty basic. It's not anything new. It's returning back to product, customer innovation, and going back to full price selling to maintain brand health. That is retail 101 playbook for any brand, and he's just going back to the roots. So I think the strategy is right. It's whether the customer will respond and whether they will drive enough innovation, but innovation with performance. I think that's what you need from an athletic wear brand, and that's where they need to put the focus.
Poonam, how's the holiday shopping season shaping up? What are the expectations?
The expectations are at least for online. We think online will continue to gain share over the holiday season. We do see strength. I mean, I cover Amazon as well, and I think Amazon's going to have a great holiday season. In terms of the broader retail, I think what you'll see again is a bifurcation in trends. The retailers that push the pedal on price and have the product the consumers desire will take share, but then those in the middle still stand to fall behind. And that's been the case for many years now. It hasn't changed.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.